In the world of investing, one name stands tall, a beacon of wisdom and insight: Benjamin Graham. Often hailed as the Godfather of Investing, Graham fundamentally transformed the landscape of financial strategy. Born in the early 20th century, he weathered the storm of the Great Depression, using the period's economic turmoil as a crucible to forge his unique investment philosophy. Graham's focus was not on quick profits, but on sound, long-term investments. He pioneered the concept of value investing, a strategy that involves buying stocks at less than their intrinsic value. His approach was not just about numbers, but about the careful analysis of a company's overall health and potential for growth. One of his most famous protégés was none other than Warren Buffett, who has frequently credited Graham's teachings as the foundation of his own investment strategies. Graham's magnum opus, The Intelligent Investor, remains one of the most influential books in the world of finance. At the heart of Graham's teachings is a concept that has shaped countless investment strategies: value investing. Picture this: you're at a bustling marketplace and you spot a stall selling antiques. You see a piece that catches your eye. It's underpriced, and you can tell its worth is much more than the price tag suggests. That's value investing in a nutshell. Value investing is the strategy of selecting stocks that trade for less than their intrinsic values. It's about digging deep, doing your homework, and understanding the fundamentals of a company. It's not about quick profits or getting rich overnight. Instead, it's a long-term game. It's about finding those hidden gems, those businesses that are undervalued by the market, and patiently waiting for the market to realize their true worth. It's about finding bargains, buying them cheap, and holding on to them until they pay off. As Graham wrote, "Price is what you pay. Value is what you get." Another cornerstone of Graham's philosophy is the margin of safety. This concept is crucial to understand if you're venturing into value investing. So what is this margin of safety? Imagine it as a buffer, a safety net that protects you from the unexpected. It's the difference between the intrinsic value of a stock, which is the actual true worth of the company, and its market price. Let's say you've done your homework and determined that a particular stock's intrinsic value is higher than its current market price. This difference, this gap, is your margin of safety. It's your cushion against errors in judgment or unforeseen market downturns. It's like buying an umbrella before a rainstorm. You might not need it, but it's good to have just in case. This margin of safety doesn't guarantee profits, but it does reduce potential losses. In the words of Graham, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Graham believed that understanding the business is key to intelligent investing. This is a principle that Benjamin Graham emphasized time and again. It's not just about crunching numbers or following market trends. It's about delving into the heart of the company, understanding its operations, its competitive landscape, and its long-term vision. It's about asking the hard questions. What does this business do? How does it make its money? What are its strengths, weaknesses, and opportunities for growth? This deep understanding enables investors to make informed decisions. It helps them to separate the wheat from the chaff, to identify those businesses that are fundamentally strong and poised for growth, and to avoid those that are just riding the wave of market hype. It allows them to spot potential risks and challenges before they become costly mistakes. So let's take a leaf out of Graham's book and remember, investment is most intelligent when it is most businesslike. Finally, Graham taught that investing should be about earning profits over time, not overnight. This underpins the principle of patience in the grand theatre of investment. Graham constantly underscored that investing is a marathon, not a sprint. He emphasized the need to think long-term, to give your investments the time to mature and yield significant returns. He cautioned against the allure of trying to time the market or chasing after hot stocks. His belief was that such strategies often lead to disappointments. Instead, he advocated for a steady, disciplined approach to investing, buying and holding high-quality stocks and allowing compounding to work its magic was his recommended path to wealth creation. In the words of Graham himself, the individual investor should act consistently as an investor and not as a speculator. So let's not be swayed by market sentiments or trends, but rather focus on sound, analytical decisions. Remember Graham's wisdom. The stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analysis are right.